Most people believe financial crises are caused by sudden shocks, bad loans, stock market bubbles, reckless banks, or unexpected economic downturns. But what if these events were only the surface-level symptoms? What if, behind every crash, collapse, or recession lies an invisible structure, a hidden architecture built over decades, quietly determining who benefits, who loses, and when the next crisis will happen? And what if that architecture has been shaping our world far longer than anyone realizes? To uncover how this framework was built, we have to start long before modern banking existed. Early markets depended on trust, physical resources, and the ability of people to exchange real goods. But as soon as merchants and early financiers discovered that paper promises could move faster than physical goods, a new form of economic power emerged. One that was not based on production or trade, but on the control of information and the manipulation of expectations. This shift laid the foundation for the first major financial bubbles. In the 17th century, when stock markets were young and nations were racing for global dominance, financial elites realized they could fuel expansion not by increasing real output, but by expanding credit. The Dutch tulip mania and the South Sea bubble were not accidents. They were early signs of how financial systems could be structured to amplify optimism, inflate assets, and then collapse under their own weight. Governments soon recognized that these cycles, while destructive, had a strange advantage. They allowed the state and powerful financiers to reshape economies, consolidate wealth, and redirect resources under the cover of crises. But to maintain this system, they needed institutions capable of controlling the flow of money itself. That led to the rise of central banks. When the Bank of England was established in 1694, it introduced a revolutionary idea. Money could be engineered. Instead of relying on gold or trade, the state could borrow from private financiers who created credit out of nothing. This was the first layer of the hidden architecture and arrangement where money creation became centralized, but controlled by a partnership between governments and private elites. As European empires expanded, so did the architecture. Financial institutions grew, bond markets exploded, and global trade became intertwined with global debt. Crises became more frequent, and each collapse revealed the same pattern: a long period of credit expansion, followed by a sudden loss of confidence, followed by government intervention that ultimately strengthened the power of financial institutions. By the time the Industrial Revolution took hold, the architecture had grown more complex. Railroads, factories, and global shipping required massive capital that could only be supplied by banks willing to lend far beyond the limits of their physical reserves. This credit-driven industrial expansion created unprecedented growth, but it also made economies increasingly fragile. Every boom sowed the seeds of the next bust. In the late 19th century, repeated financial panics in Europe and the United States made it clear that unregulated markets were vulnerable. But instead of decentralizing financial power, policymakers responded by centralizing it even further. The creation of the U.S. Federal Reserve in 1913 was a pivotal moment. It marked the consolidation of monetary authority into a small circle of decision-makers who would determine interest rates, control liquidity, and act as lenders of last resort. World War I pushed this architecture into overdrive. Nations borrowed heavily to fund the war, and when the fighting ended, they found themselves trapped in a web of debts that could never be fully repaid. To restore stability, countries attempted to return to the gold standard, but the system no longer reflected economic reality. Currencies were overvalued, debts were unmanageable, and capital flowed in destabilizing waves. The Great Depression was the inevitable breaking point. When banks failed and markets collapsed, millions of people believed the crisis was caused by speculation or economic mismanagement. But the deeper truth was that the financial system itself had been engineered around fragile assumptions that could not withstand a global shock. The architecture cracked, revealing how tightly connected the world economy had become. Policymakers responded by reshaping the architecture once again. During World War II, governments controlled production, prices, and capital flows. After the war, world leaders gathered at Bretton Woods to build a new system that would prevent future crises, while keeping global finance under coordinated oversight. The IMF, the World Bank, and a dollar-based monetary order were created to stabilize currencies and guide economic development. But even this new framework had hidden weaknesses. By tying currencies to the US dollar and tying the dollar to gold, the system depended on America maintaining fiscal discipline. By the 1960s, however, the U.S. was printing dollars far faster than it could back them. Foreign nations saw the imbalance and began demanding gold. The architecture was once again at risk of collapse. In 1971, President Nixon ended the dollar's convertibility to gold, severing the last link between money and physical value. From that moment forward, the financial world entered an entirely new era, one in which money could be created in limitless amounts, controlled by central banks, and directed by financial institutions that now had unprecedented freedom. The architecture evolved into a system dominated by floating currencies, global capital flows, and rapid financial innovation. The deregulation waves of the 1980s removed many of the safeguards put in place after the Great Depression. Banks were allowed to take greater risks, create complex financial products, and leveraged their balance sheets far beyond traditional limits. These changes produced spectacular growth, but at the cost of rising instability. The Latin American debt crisis, the Asian financial crisis, and the collapse of long-term capital management all expose the same underlying issue. When financial markets are deeply interconnected and highly leveraged, small shocks can trigger global waves of panic. The hidden architecture behind these crises relied on a simple mechanism: expand credit during good times, allow asset bubbles to form, and then intervene when the system nears collapse. This cycle concentrated wealth among those who controlled financial assets, while ordinary citizens bore the brunt of recessions, austerity, and inflation. The 1990s brought another layer to the architecture: the rise of technology markets and speculative valuations. Investors poured money into companies with little revenue and no profits, convinced that innovation alone justified their soaring prices. When the dot-com bubble burst in 2000, trillions in paper wealth disappeared. But once again, central banks stepped in, lowering interest rates and restoring liquidity. These interventions prevented a deeper collapse, but they also created the conditions for the next crisis. Cheap credit fueled a housing boom, aggressive lending, and widespread speculation. Banks packaged risky mortgages into financial products that were sold globally. Rating agencies stamped them as safe. Investors bought them in massive quantities. The architecture had become so complex that few understood the risks embedded within it. When the housing bubble burst in 2008, the entire system unraveled. Major banks collapsed. Global trade froze, and economies worldwide entered freefall. Governments responded with bailouts, stimulus packages, and unprecedented monetary interventions. These actions prevented a complete meltdown, but they also entrenched the architecture even further. After 2008, central banks adopted a new tool: quantitative easing. By injecting trillions of dollars into financial markets, they inflated asset prices, kept borrowing costs low, and encouraged speculation. Stock markets hit record highs, but wages stagnated, inequality surged, and real economic productivity lagged. The architecture succeeded in stabilizing markets, but not in improving the lives of ordinary people. This divergence between financial markets and real economies has become one of the defining features of the modern world. Growth increasingly comes from expanding credit, not from innovation or production. Debt has become the primary fuel of economic expansion, and financial institutions have become more powerful than ever. The pandemic in 2020 revealed just how dependent the architecture is on constant intervention. When economies shut down, markets should have collapsed. Instead, central banks printed trillions, governments issued massive relief packages, and asset prices soared. Billionaires saw historic gains, even as millions lost their jobs. The architecture once again preserved itself, but only through extraordinary measures. Today, global debt exceeds $300 trillion. Interest rates remain heavily influenced by central bank decisions. Financial markets continue to dominate economic policy. And despite repeated failures, the architecture remains intact largely because dismantling it would mean unraveling the entire global economy. This brings us back to the mystery at the beginning. Why do financial crises keep happening despite endless reforms, regulations, and interventions? The answer is that the architecture behind the financial system is designed to be fragile. It relies on credit expansion, speculation, and the constant belief that tomorrow will always be more prosperous than today. When that belief falters, the system trembles. Every crisis reveals the same three patterns: excessive leverage, concentrated financial power, and the belief that markets can self-correct. These forces shape every major collapse, from 1929 to 2008 to whatever comes next, and they all stemmed from an architecture built to prioritize growth, liquidity, and profit, often at the expense of stability. Three lessons emerge from this history. First, financial crises are not anomalies. They are features of a system built on fragile foundations. Second, the institutions meant to prevent crises often end up reinforcing the forces that create them. And third, understanding the architecture behind modern finance is essential for predicting how future crises will unfold. The coming decades will test this architecture more severely than ever. Rising debt, geopolitical tensions, climate risks, and technological disruption will strain a system already stretched to its limits. Whether the architecture can survive these pressures is uncertain, but what is certain is that ignoring it will only make the next crisis more devastating. If this deep dive helped you understand the hidden structure shaping every major financial collapse, consider staying connected with the channel. The more we uncover the systems behind global events, the better prepared we are for the changes ahead.